Financial reporting options. It's a simple formula. Credible reporting equals better results. It's astonishing how many small business owners are not aware of the effect of financial statements and financial reporting choices can have on the overall success and growth of their business. The proper selection of the most appropriate financial reporting option for one's business can have a substantial impact on the entity's ability to remain fiscally healthy and continue to strive and grow. With this in mind, having transparent and credible financial reporting can be significant in contributing to an entity's ability to obtain insurance and bonding, to obtain loans, to obtain customers and suppliers, to obtain more competitive financing rates, and to obtain a higher selling price if and when they sell the business. And also to trigger fewer government audits, which is very important. It's unfortunately that too many small business owners often do not have the true sense of financial reporting options that are available to them. After reviewing the brief list, however, it becomes quite clear that selecting the appropriate type of financial reporting for one's business is a decision that should not be overlooked and should not be taken lightly. It warrants any business owner's attention, no matter the size of the business. What are my financial reporting options? There are three options. The first one is what they call a notice to reader, which the second is a review, and the third is an audit, and we will talk about all. Each option carries a different level of credibility, different level of assurance, and comfort for the outside world. Remember, financial statements are your presentation of your financial results to the outside world. So the higher the level of credibility, the higher level of assurance, the more that the individuals on the outside are going to trust your statements. So the question that has to be asked is, what level of assurance is appropriate for my business? Do I need my financial statements just for tax purposes? Then maybe a notice to readers, that's all that's required. Do I need my financial statements to get financing? Do I need it to go to get better suppliers? Then a review or an audit may be appropriate. It goes back to, who are you using the financial statements for? Banks, insurance companies, or the government, or external suppliers, as I mentioned also. Let's review the three different financial options, starting with the notice to reader. Notice to reader is basically taking the external financial statements and compiling them, putting them into a financial statement that gets sent to the government. We as accountants do not give any level of assurance to the numbers. We don't look at the numbers. We don't audit the numbers. The numbers are just put on a piece of paper and we send them off, usually for tax purposes. These reports are not sufficient, usually not sufficient for external users such as banks and bonding companies. So in anticipation, and this is the important thing, in anticipation to obtaining financing in the near future, or in anticipation of obtaining bonding in the near future, then one should look at the other options, not when they're asked, but before they're asked. And this shows that you have a level of understanding on how to run your business effectively, because you're anticipating problems and you're basically working towards rectifying those issues, and you're becoming a lot more transparent to the outside world. So therefore, you have credibility in your numbers, and you're showing the outside world that you have credibility in your numbers. A review engagement allows a certain level of assurance. In other words, external accountants perform certain procedures on the financial statements, primarily analytical procedures, inquiry and discussion with management, to make sure that the numbers on the financial statements are credible, okay, as a whole. Not every individual number, but as a whole, that the statements present a reasonable basis for what the company, the financial position is at that specific point in time. And this is what a review does, but explicitly still marked as unaudited. Again, we need to determine who our users are for a review level. A review is usually given to the banks, to the bonding company, and it gives them some assurance that at least the financial statements are credible. This is usually done for small businesses, i.e. businesses with revenues less than $20–25 million. Okay, for any company higher than that, you're going to have to get an audit. So let's talk about the audited report. An audit report provides the highest level of assurance and credibility to the outside world. External accountants perform several audit procedures, including discussion analysis with management, substantive testing. In other words, you go take samples of the invoices and agreements and source documents and test them. You test the controls of a company, which is very important because that also gives the management assurance that the controls are working. Based on the results of these procedures, the accountant will form an opinion on the financial statement as a whole to whether or not they present fairly in all material respects the financial status of the organization. All things being equal, audit financial statements will allow a company to tap into greater financial resources such as capital markets, bonds, private banking, large private investments. So if you're in a growth mode, why not do an audit prior to doing a review? If you need bonding at a higher level, why not do this before? Thus, most costly financial reporting options, but the benefits definitely outweigh the costs in the long run if you want to grow the company. It's being proactive, not reacting to the financial needs of your corporation. You need to consider the users, both current and in the future, and tie that into your plan. Notice the reader may be sufficient at this time because nobody's asked for it. But if you want to go forward, you want to grow, then by you being proactive, the bank looks at you in a different light. The bonding company looks at you in a different light. The external markets look at you in a different light. It's a simple formula. Credible reporting equals better results. I'll give you one example. I have a client who builds plazas. He requests an audit every year. He doesn't have to. He can get away with a review. The audit probably doubles his cost or even triples his cost of the report. But inevitably, when he sells his business to a REIT, he gets multiples that are often unheard of in the market because they trust his numbers. And that trust will make a person pay more for your company. That trust will allow the bank to give you a better interest rate and it'll save you money in the long term. That trust will allow the bonding company to give you a higher amount of bonding. That trust will allow your supplier to give you a better price on your material because he knows that you're a solid company. That trust is not there with the notice to reader. So when you're evaluating your reporting requirements, understand that the outside world is also evaluating. It's not just yourself it's not just for you that you use those financial statements. It's for everybody else. And what's very important is that your financial statements tie into your users' needs, not necessarily to your needs.